Welcome back. It is Tuesday, March 10th, 2026. And if you have glanced at a newspaper, opened a news app, or even just scrolled through social media in the last 24 hours, you already know the atmosphere out there is incredibly tense.
Yeah, it's really palpable right now.
It is. We are looking at a world where the headlines are just completely dominated by military conflicts in the Middle East. Specifically, those recent actions involving the U.S. and Israel and Iran are taking up all the oxygen in the room. It is a moment of profound global uncertainty.
And naturally, that level of uncertainty is bleeding right into the financial markets.
Exactly. It leaves a lot of people sitting there staring at their screens, wondering how on earth you were supposed to navigate this kind of volatility without losing your mind. So that is exactly what our mission is for you today. We are taking a deep dive into a very specific, highly timely financial analysis document that attempts to answer a straightforward question. If you have $1,000 to invest right now, right in the middle of all this chaos, where do you put it?
And the research we're looking at points to one fascinating focal point in the energy sector, a company called Enterprise Products Partners LP.
Trading under the ticker EPD.
Right, EPD.
Yeah.
But before we jump into the mechanics of this, I want to establish a really important framework for our discussion today.
Sure.
The analyst who wrote this report doesn't tiptoe around the elephant in the room. They build their whole case around the current military tensions we are seeing, specifically naming the U.S., Israel, and Iran.
Right.
Our goal in this deep dive is not to take a political stance or weigh in on the geopolitical right or wrong of these events. We are here to look purely and impartially at the financial and market mechanics described in the documentation.
Just the numbers.
Exactly. We are examining how a financial analyst views geopolitical conflict as a catalyst for energy markets, and how a specific company's physical infrastructure is positioned to react to those global shifts. It is strictly an exercise in understanding market reactions to real-world volatility.
Okay, let's unpack this. The analysis makes a rather bold claim right out of the gate. In a world that is constantly chasing the next big tech breakthrough or the next flashy startup, it suggests that the smartest place to put your $1,000 right now is into a company that essentially operates a giant physical toll road for energy.
A massive toll road.
We are talking about Enterprise Products Partners, and the sheer scale of their asset footprint is hard to wrap your head around. They operate over 50,000 miles of pipeline.
Which is just staggering.
Right. Just to visualize that, 50,000 miles is enough steel pipe to wrap around the Earth at the equator twice.
Twice. That is a lot of steel.
It really is. And it's not just pipes hidden in the dirt. The breakdown shows they own immense liquids storage facilities, natural gas processing plants, and fractionators. Now, for those of us who don't spend our weekends hanging out at refineries, what exactly is a fractionator?
Well, a fractionator is essentially a massive industrial sorting machine. When raw hydrocarbons come out of the ground, they are a messy mix of different elements. A fractionator separates that raw feed into distinct, usable products like ethane, propane, and butane. But to understand where EPD fits in, it helps to use an analogy.
Let's hear it.
The energy sector is broadly divided into three parts. You have upstream, which are the companies actually drilling the holes in the ground and taking the risk to find the oil.
The explorers.
Right. Then you have downstream, which includes the refineries turning it into gasoline and the gas stations selling it to you at the pump. EPD operates in what is called the midstream.
The middleman.
Exactly. Midstream essentially means they are the delivery drivers and warehouse managers of the energy world. They don't drill the oil, and they don't sell you the gas at the pump. They just handle the processing, the storage, and the transportation of everything in the middle.
That makes perfect sense. So they are the logistical backbone. But why does this specific analyst think that logistical backbone is the place to be right now, given the military conflicts we mentioned at the top of the show?
You have to look at the cause and effect taking place in the global energy market. When production in the Middle East is disrupted, or even when the market simply fears it might be disrupted because missiles are flying, the global supply chain panics.
Sure.
Buyers around the world scramble for reliable, secure sources of energy from places that aren't actively in a conflict zone. That dynamic creates a massive surge in demand for United States oil and gas exports.
But they can't just instantly ship it out.
Right. Here is the critical bottleneck. That U.S. oil and gas cannot magically teleport from a drilling site in Texas or North Dakota to a cargo ship bound for Europe or Asia. It has to be processed, it has to be stored, and it has to be physically transported to those export terminals.
And that is the exact service Enterprise Products Partners provides.
Precisely. So a geopolitical disruption in the Middle East translates directly into a higher volume of product flowing through EPD's domestic infrastructure.
And looking at the market data provided, investors are clearly catching on to that dynamic. As of yesterday's market close, which is March 9th, 2026, EPD's unit price was sitting at $37.09.
A solid jump.
Yeah, that is a 16% climb year to date. In just a little over 2 months, jumping 16% is a fantastic run for a company this size. But there's a detail in the research that stood out to me.
What's that?
The analyst notes that investors have flocked to EPD, but they haven't been the absolute biggest winners in the energy sector during this recent spike. Shares of the upstream exploration companies, the drillers, have seen even larger gains. If the energy market is booming right now, why aren't the delivery drivers seeing the exact same massive spikes as the drillers?
What's fascinating here is the fundamental trade-off the research highlights between an exploration company and a midstream company. Exploration companies are highly leveraged to the price of the commodity itself.
Okay, so if the price of crude oil skyrockets from $70 to $120 a barrel,
An upstream driller's profit margins absolutely explode, and their stock price shoots to the moon. But that leverage is a double-edged sword.
because if oil prices crash down to...
To $40 a barrel, exactly.
Yeah.
Those same exploration companies can face catastrophic losses, mass layoffs, or even bankruptcy because it costs them more to dig the oil out of the ground than they can sell it for.
That's terrifying.
It is. The analyst specifically praises EPD because it represents a completely different philosophy. They offer a unique combination of upside potential with downside protection. You are getting the benefit of increased volume driven by these geopolitical catalysts, but without the extreme sleep-losing volatility that comes from trying to guess the day-to-day price of a barrel of crude oil.
Here's where it gets really interesting, because the report makes a point that feels entirely counterintuitive for an energy stock. It explicitly states that Enterprise Products Partners' fortunes do not rise and fall strictly with commodity prices.
It's true.
That is a wild thing to read about a company that is 100% entrenched in the oil and gas sector. But you just touched on it with the midstream analogy. It goes back to the idea of being a toll road, right?
Precisely. If you own a toll road, you don't care if the truck driving on your road is carrying a shipment of cheap gravel or a shipment of solid gold bars. You charge a fee for the use of the road.
Makes sense.
EPD is getting paid a fee for the movement, storage, and processing of the hydrocarbons, largely regardless of what that barrel of oil or cubic foot of natural gas is trading for on the open market. And what is compelling about this analysis is that it doesn't just ask us to take their word for it in theory.
Right, the stress tests.
The analyst provides a historical stress test to prove this concept of downside protection. They point to 3 distinct, massive global crises where EPD maintained its stability and its cash flow.
And these weren't just minor market dips. The first one they highlight is the financial crisis of 2007 through 2009.
That was a period where global credit markets literally froze.
The entire banking system was teetering on the brink of absolute collapse, and lending just stopped. Then, the report points to the oil price collapse of 2015 through 2017.
That is a perfect example of a crisis that absolutely devastated the exploration companies we were just talking about. Drillers were going bankrupt left and right, rigs were shutting down across the country, but EPD kept collecting its tolls.
And the third stress test is perhaps the most dramatic.
The COVID-19 pandemic.
From 2020 through 2022, think about what happened to the energy sector during those early lockdown months. Global demand for transportation fuel didn't just drop, it plummeted overnight.
People stopped driving, airlines grounded their fleets.
At one point, the futures price of oil actually went negative because there was literally nowhere left to store it.
Yet, through all 3 of these incredibly different, historically severe economic shocks, a banking collapse, a localized commodity crash, and a global pandemic, EPD's business model held up. Their volumes dipped, certainly, but they continued to generate massive amounts of consistent cash flow.
The ultimate proof of that resilience comes down to a specific metric that the analyst highlights, which is their credit rating. The report notes that Enterprise is the only midstream energy infrastructure company with an A- credit rating.
The only one.
In an industry that requires billions and billions of dollars of capital expenditure just to build and maintain these pipelines and processing plants, having an A- rating is essentially a financial superpower.
It truly is. It means the major ratings agencies have stress-tested their balance sheet, looked at their debt structure, and decided they are the absolute safest, most reliable bet in their entire sector. They are standing entirely alone on that tier.
Incredible.
But as we move further into the analysis, the document introduces a fascinating pivot that completely shifts the narrative. We started this discussion focused heavily on geopolitical conflict and the Middle East as the primary catalyst for EPD's current success. However, the analyst states very clearly that this company does not actually need geopolitical conflict to thrive. They were already experiencing rampant organic growth long before these recent tensions flared up in the news. And the primary driver of that growth is something completely removed from foreign policy.
I know exactly what you're talking about.
It is the rapid, almost frantic buildup of data centers.
The data center boom. This completely caught my eye because it bridges the gap between the old physical economy and the new digital one in a way you rarely see.
It really does.
And honestly, the source material itself features this incredible, almost comedic juxtaposition right in the middle of the text. Right after the analyst is breaking down pipeline volumes and the COVID pandemic, there is an insertion, what looks like an advertisement or a promotional call-out for a separate newsletter.
Yeah, that promo ad.
It's asking in bold letters, will AI create the world's first trillionaire? It talks about a little-known tech stock, calling it an indispensable monopoly that owns technology that NVIDIA, AMD, and Intel cannot function without.
It's so jarring.
Finding this tech bro, hype-driven, trillionaire ad smack in the middle of a sober, conservative analysis of steel pipes and natural gas is hilarious. It's like finding a neon flyer for a Vegas nightclub tucked inside a dusty encyclopedia.
If we connect this to the bigger picture, the irony of that juxtaposition within the text is incredibly revealing about the state of our modern economy. You have the flashy, speculative world of artificial intelligence, the pursuit of trillionaires, the endless obsession with microchips from companies like NVIDIA and AMD, sharing the page with a company that lays steel pipes in the dirt.
Yeah.
But the profound truth that the analyst is hinting at is that the former literally cannot exist without the latter. Artificial intelligence, for all its digital extraction and cloud computing buzzwords, is intensely physical in its requirement.
Because of the servers.
Right. The sprawling data centers required to train and run these advanced AI models consume gargantuan amounts of electricity.
Yeah.
To power those data centers reliably, 24 hours a day, 7 days a week, the power grid requires a massive, steady supply of baseload energy.
And wind and solar are intermittent.
Exactly. They need a reliable backup.
Yeah.
In the U.S., a huge portion of that reliable, always-on power comes from natural gas.
So what you're saying is the unglamorous physical energy infrastructure provided by companies like EPD is the foundational layer that makes the entire trillion-dollar AI boom possible. You don't necessarily have to pick the winning microchip company. You just provide the fuel for the power plant that keeps their servers from shutting down.
Exactly. The analysis is showing us that EPD is, in a very real way, a backdoor play on the AI revolution.
Yeah.
And while they are benefiting from that tech-driven surge in energy demand, the report also notes that they are heavily shielded against one of the biggest economic threats facing every other sector right now, which is inflation.
Right, the inflation armor. How exactly does a pipeline company protect itself when the cost of everything else is going up?
It comes down to the way their contracts are structured. The data shows that roughly 90% of EPD's long-term contracts have escalation provisions built right into them.
Okay, meaning?
That means if the broader economy experiences inflation, say, the cost of labor or the cost of replacement steel goes up, EPD's contracts automatically adjust their fees upward. They just pass those inflationary costs along to their customers. 9 out of 10 of their long-term deals guarantee that inflation will not eat away at their profit margins.
So what does this all mean? Having inflation armor and a monopoly on the power needed for AI data centers sounds great in theory, but does that actually translate to the balance sheet? If I am a listener looking at putting my $1,000 here, I need to know what's under the hood. Just how big is this operation, and is it actually profitable?
It is massive. We are looking at a market capitalization of $80 billion. This is an incredibly entrenched blue-chip enterprise. Looking at the breakdown provided in the report, they are operating with a gross margin of 12.86%.
Very healthy.
But the metric that really seems to impress the analyst, the one they spend the most time highlighting, is their return on invested capital, or ROIC.
Break that down for us. What exactly is ROIC, and why does this analyst care about it so much?
Return on invested capital is widely considered one of the purest measures of an executive management team's ability to allocate capital efficiently. Simply put, it tells you how much profit a company generates for every dollar they invest back into their own business.
Got it.
The numbers in this report show that EPD's ROIC have been in the double digits every single year since 2005. Furthermore, they have maintained an average ROIC of 12% over the last 10 years.
Wait, 12% sounds like a solid number, but in a world where tech stocks sometimes jump 50% in a single year on a good earnings report, why is a steady 12% so impressive to the analyst who wrote this?
Because of the industry they operate in,
Yeah.
midstream infrastructure is incredibly capital intensive. You are constantly spending billions of dollars to lay new pipeline, upgrade processing plants, and maintain environmental safety standards.
You're just burning cash to keep things running.
Exactly. In an environment where you are burning through cash just to maintain your physical assets, sustaining a 12% average return on every dollar deployed is a testament to incredibly disciplined management. It means they aren't just building new pipelines for the sake of expanding their empire. They're only funding projects that they mathematically know will generate a substantial, reliable return.
So how does that disciplined management translate into cash in my pocket if I buy their stock? The analyst spends a lot of time talking about something called a distribution instead of a dividend, and points out that EPD is a master limited partnership, or MLP. Can you give us the plain English translation of what an MLP actually means for someone's portfolio?
Certainly. A master limited partnership is a unique tax structure utilized primarily in the energy infrastructure space. Without getting bogged down in the tax code, the fundamental takeaway is that an MLP does not pay corporate income tax at the entity level.
Oh, that's a huge benefit.
It is a massive tax benefit. However, in exchange for that, the structure requires the company to pass almost all of its available cash flow directly to its investors. That cash payout is called a distribution rather than a traditional stock dividend.
And according to the research, that distribution is incredibly lucrative right now. The analyst actually uses the word juicy to describe it.
Juicy is definitely accurate.
Right now, that distribution yield is sitting between 5.86% and 5.9%. Now, the text notes that this percentage is actually near its lowest level in 5 years, but there's a good reason for that, right?
Yeah, it's simply because the unit price has gone up 16% this year.
Which mathematically pushes the yield percentage down.
Exactly. But even at a 5-year low, getting a near 6% cash yield is massive, especially compared to the broader market average.
It is substantial.
But as the analyst is quick to point out, it is not just the current yield that matters, it is the historical trajectory of that yield. The report emphasizes that EPD has increased its distribution for 27 consecutive years.
Let that sink in for a second. 27 consecutive years.
It's incredible.
That means through the 2008 banking collapse, where credit disappeared,
Right.
through the brutal oil crashes where drillers went bankrupt, and through the 2020 pandemic where oil prices literally went negative every single year for nearly 3 decades, they have given their investors a raise.
Exactly. In fact, the most recent data shows they just increased their distribution by another 2.8%. And importantly, they are doing this while maintaining ample financial flexibility.
Meaning they aren't going into debt to pay it.
Right. Because of that disciplined capital allocation we discussed earlier, they aren't borrowing money to pay these distributions. They are funding them entirely from their massive internally generated cash flow, and they still have enough cash left over to buy back their own units.
Which takes shares off the market and further increases the value of the remaining units for the investors holding them.
Precisely.
That 27-year streak is amazing. It's older than some of the tech billionaires building the AI models we were talking about earlier. But there is one final piece to this puzzle that the analyst highlights, and it might be the most reassuring data point for anyone thinking about trusting this management team with their money.
Insider ownership.
Yes, a look at who actually owns the company. The research notes that around 1/3 of Enterprise's common units are owned by its general partners management and their affiliates.
That concept is broadly referred to in finance as having skin in the game. When 1/3 of a massive $80 billion enterprise is personally owned by the executives who are running it, it completely aligns the interests of management with the interests of the everyday retail investor.
Because they have so much to lose.
Exactly. If the executive team makes a reckless decision that hurts the unit price or threatens that 27-year streak of distribution raises, they're not just facing a theoretical penalty or a stern letter from a hedge fund. They are taking a massive, immediate hit to their own personal wealth. The analyst notes that this level of insider ownership is a phenomenal sign.
It breeds exactly the kind of conservative risk management and disciplined capital allocation that results in those double-digit returns on invested capital.
It does.
It changes the whole dynamic when the captain is required to go down with the ship, right? Or in this more optimistic case, when the captain gets rich right alongside the passengers.
It really does.
So, bringing this all back to you, the listener, we started this deep dive looking at a terrifying global landscape. We have tense military conflicts, profound uncertainty in the Middle East, and the frantic, almost dizzying hype of the AI tech boom dominating every screen we look at.
It's a lot to process.
It is. In an era completely saturated by information overload and flashy, anxiety-inducing headlines, it is so easy to feel paralyzed when trying to make a financial decision. But understanding the actual physical mechanics of a company like EPD teaches us a masterclass in risk management.
True financial resilience.
Exactly. It shows us that true financial resilience doesn't always come from trying to guess the geopolitical news cycle or chasing the hottest new tech startup. Often, long-term stability and growth are found in the boring infrastructure, the 50,000 miles of steel pipe hidden in the dirt.
The essential, everyday toll roads that literally hold the modern world together.
Exactly. That is where you find a fortress balance sheet and a business model built to survive the chaos.
This raises an important question, though, one that builds directly on that hilarious juxtaposition you pointed out in today's research material. We saw a sober analysis of traditional energy infrastructure literally interrupted by an advertisement promising the monopolistic power of AI tech giants.
Right.
But as we've established today, that entire digital revolution is completely bottlenecked by physical reality. The massive data centers and the cloud computing algorithms cannot run without uninterrupted, massive increases in baseline power generation. So I want to leave you with this thought to consider.
Okay.
If the next wave of the tech revolution fundamentally relies on the massive expansion of traditional physical energy infrastructure, might the true, long-lasting monopolies of the digital age actually turn out to be the old-school utility and pipeline companies that literally keep the server's lights on?
Wow. The real trillionaires of the future might just be wearing hard hats instead of hoodies.
Exactly.
I absolutely love that perspective. Thank you for joining us on this deep dive today. We hope this exploration helped you cut through the noise and look at the market from a slightly different, maybe more grounded angle.
Keep questioning those headlines.
Yep. Keep questioning the flashy headlines. Keep looking for the hidden infrastructure behind the news. And we will catch you on the next deep dive.